Hey everyone, welcome to CoveredCall ETF Investing. I'm Jordan, and today, very excited to bring to you a video that's quite different. Now, like it says in the title, apologetics. You're probably wondering, what the heck is that? Should we be apologizing and being meek about our investment strategy for income? No, of course not. We should be fierce warriors for that and be able to defend our positions well. And so that's what it's all about. Apologetics is actually the Christian term for defending the faith. So I wanted to bring to you a video. Maybe it'll turn into a series. Who knows? Ways in which we can defend ourselves and get you guys equipped with arguments where people might just be curious and have questions. But, there's obviously trolls and skeptics and just people with sort of malicious intent to try to undermine how exactly you're investing, maybe make you feel bad about it. I don't know, but these are some ways that you can communicate why you invest the way you do and how it's different from the vast majority of how people invest. So let's get into our first argument. So the very first argument you're probably going to face, you probably heard it a ton, especially if you've had some sort of exposure to CoveredCall ETFs, is that they can't beat the market, or more, I would say the more common language is they can't keep pace with the market. Usually that's a reference to the S&P 500. So I'll give you an example of my portfolio as a total, and then I'll give you an example of what funds have beat the S&P 500 in the year 2024. So we don't have a huge amount of time to go off of, but for my portfolio, it's about 2 years, and I'll give you a 1-year example for those other funds. But in this case, if someone says something along the lines of, it can't keep pace with the market, you could really throw them off and be like, who cares? Like, my goal is not to beat the market. I don't care what the market is doing. Like, having some growth in your portfolio, you could say, like, yeah, that's important. I want my funds to be able to naturally grow themselves out of a ditch if the market ever gives it one. I'm investing to enhance my quality of life, to extract that income and put it towards the purposes of maybe it's your family experience, to offset some sort of cost. In my own life, I've talked at length about using CoveredCall ETFs from the eventual sale of my home, so that I can get into a bigger place, offset a rental cost, and pretty much get double, maybe triple the size, and where I'm virtually not paying anything else really out of pocket. Like, my expenses are either the same or they actually decrease. And so for me, CoveredCall ETFs are more of a lifestyle choice, but I can also turn them into a growth strategy as well, which is great, and just reinvest. And so this is what it looks like, at least on the reinvesting and contributing and not really living off of it portion, which is my TFSA, my wife's spousal RSP, my personal RSP. And so this is over the last 2 years, total return. My portfolio is slightly edging out the S&P 500. So I'm into a batch of diversified funds, mostly all-in-ones. So these are ETFs that invest in other ETFs, mainly like, say, sector funds, and they're kind of all just kind of cobbled together into one spot. So that's how I like to invest, to stay diversified and really just keep it simple. I dollar cost average. I don't overcomplicate this. Dollar cost average, diversified funds that yield somewhere between 10 and 12%. That's my strategy in a nutshell, and I keep contributing, and look how well that's done over the last 2 years. So this notion that these things can't beat the market, well, I mean, we'll see what the next 10 years does, but at least so far, especially in a bull market like this, the S&P 500, as told, it's supposed to pull away from these CoveredCall funds, but depending on how you kind of set these things up, hey, they can keep pace. So the next example is funds that actually beat the S&P 500. So we got the S&P 500 right here. This is filtered by total return here in the CoveredCall ETF All-Star Tracker, which, by the way, I got a special going on right now, 50% off. You can find it down in the description below. Instead of it being $100, we're back down to $50 for 4 days. So if you're watching this on the Valentine's Day long weekend, if you see this on Family Day, you'll still be able to pick it up for $50. But end of day, February 17th, it's going to be back up to $100. So make sure you get it before then, because it's a fantastic resource that I've built for all of you for all of your income investing needs. So much great stuff in here, and the description below will give you an idea of what is included in that. So let's see what's above the S&P 500 total return, and it did about 24.77%. We got like funds like bank. A lot of financials would have done well in 2024, especially on the back half as interest rates had fallen. We got some single stock ETFs in there, some concentrated tech funds in there. So as we move up the list, but what I'm more curious to see is what kinds of diversified funds do we have. So maybe let's just go over here. We'll look at what's above the S&P 500, what sectors beat it out. So we see a lot of financials. We do have some diversified US stuff. Once again, more diversified US, USCL. Actually, USCL probably did really well last year. Yeah, I mean, my goodness, 30. Imagine you invested in the S&P 500 with a covered call strategy with a leverage on top of it. It would have gotten you a 36.23% return last year. Absolutely incredible. If you don't mind leverage and you don't mind tacking it on for the long term. But at least it goes to show there are diversified funds that can beat the S&P 500 and by a wide margin. I get it. It's just 1 year. Can't wait to see what the next 10 years is, but I still got to give examples here in the short term, especially as the tracker builds out and we get more history behind it. Okay, so the next argument that you might face is covered call ETFs are not safe. This probably comes out of more of a spot of people just don't know, they're not educated on this, and because it seems like a trend, it doesn't seem safe. Maybe I think that's kind of where it comes from. So this is where you can ask some questions, because I think there are legitimate questions to see if people know. And so this is how you can kind of follow up on some sort of question around covered call ETFs aren't safe. And that would be, well, let me ask you this. Do you know how long covered calls have been around for? Do you know how long options contracts, like the history of all this stuff, how long has it been around for? They probably won't know. And then you could ask, like, how long have ETFs been around for? They'll probably say, I don't know. Okay. Well, let's think of it like this. ETFs have roughly been around since 1994. That's when the first one came out. Then when we talk about actual index funds, those have been around since 1976. So we got a good long track record of index style of investing. And they'll say, okay. And you'll say probably, well, do you use ETFs? Most likely the other person might. Like, well, what do you think of ETFs in general? Do you think those are safe, unsafe? They'll probably say, well, no, I mean, I think they're fine. They should say that they're fine because they're an excellent mechanism to invest in. If you're maybe someone who just wants to participate, you're someone who's maybe busy and you don't have the time to stock pick, ETFs are an excellent way to get your money participating and building for you. That's kind of your response around ETFs. It's easily accessible. Barrier of entry is really low. They'll say, okay. So maybe they'll agree on that point, right? Because the art of this, albeit I don't think I'm a master of this kind of stuff, but it's just sort of common sense, especially if you know what you're talking about, right? Is to win people over, make them agree with you, or get them to agree with you, not strong arm them into agreeing with you, right? Like wagging the finger, telling them, come on now, get with the program. This is how it is. Don't you see? Don't you see? So the next point would be, okay, well, we've established ETFs are pretty normal. They have their use cases. And let's think about the next one, covered calls. Those have been around for a long time. They might say, well, yeah, I've heard of them. Yeah, so people can individually write on them. Institutions do this all the time. All the stinking time they do this, right, to hedge for their clients. Maybe you can even teach them. They're like, look, do you know how options contracts even came to be? Do you know where they all started? And this is where you could have some fun with this and be like, just guess the decade, okay? And they'll probably say, I don't know, the 1920s, 1930s. They'll probably say something like that. And this is where you'll get to have fun. You'll say ancient Greece, actually, is roughly when the first sort of options contracts were, we think that it all kind of started. There wasn't necessarily like stock markets back then. But the idea back in like ancient Rome was to like speculate on the olive harvests by setting the price of the use of, I guess, presses for olives. There is a little bit of history that you can kind of throw in there that people can kind of muse over. It's kind of the same deal, right? In the more modern era, is it all kind of started around like hedging against harvests and agriculture and things of that nature. So they've been around. So both of these things have been around for a long time. It's just when you put them together, people all of a sudden just kind of lose their minds. Like, these things are brand new. It's like these strategies have been around for a long time. Just put them together, and people start going bonkers over this stuff. Okay, but they shouldn't. It's just combining something that's old and combining something else that's old and into just a new way of thinking about it. The way we apply this investments to our investment strategy maybe is a little bit newer, and that's what this channel is trying to show, especially for Canadians out there, how we can use these income strategies to enhance our quality of life when it feels like the quality of life has been slipping away, especially if you're someone who's wanted to buy a home or a townhouse. And I can't tell you, for me and my wife, that dream felt like it was lost a very long time ago, and we're only regaining that. And we know now that, albeit I know it's unorthodox, and I've talked about it a lot, but how we can, say, rent out a much larger space. We might not own it, but hey, we own our investments and they go where we go. And so we're going to have flexibility there. Just thinking a little bit differently about kinds of things we own to support our lifestyle. So that's one way that you can attack our CoveredCall ETF safe, and hopefully that answers that question. So the next point that you might get faced with is CoveredCall ETFs. Well, their net asset value erodes over time, or some sort of question around, well, the share price is going to go down over time, they pay out too much, and therefore they really have no ability to grow, because naturally covered calls in of themselves, they cap upside to an extent. Now, for those of you that have been doing this for a long time, you know that this is just not entirely true. It can be true, but it depends on the structure of the fund. There's a few ways we can attack this. There's one sort of quick, easy way of doing it that you could probably ask the question, be like, look, if you were a fund manager, do you think that these guys are motivated to make quick money or long-term money? And I reckon they'll probably, if they're genuine with their answer, they're going to say, well, probably long term. Like, exactly. Why would fund managers with good reputations want to create garbage products, maybe to capitalize on a trend, only for it to fizzle out and draw the ire of the community? They ruin their reputation. There ends up being an AUM drawdown of not just maybe that fund, but other funds as well, because now they're not a trustworthy fund manager. They're not good stewards of the very funds that they have created. So it is incumbent on fund managers to create good products for the long term, for those who want to extract income, especially those who have been retired and rely on these products for their daily living. So that's one way. Another way, it's a little bit longer, but and it also depends too. Is the person asking from a malicious point of view? Is someone asking more from a curious standpoint? There's a way then we could probably be more agreeable without surrendering our position. So one way of maybe doing that, especially on the more curiosity side of things, I do believe you're going to probably face more of that. Once again, funds are created very differently. They're not created exactly equal. And if you stay on top of this stuff, this is where you can kind of break down this fund versus that fund versus that fund versus that fund, and just try to easily explain those structures, right? In some cases, you got portfolios that only write coverage on 30% of the portfolio, 50% of the portfolio, meaning that the rest of that portfolio is unbound. It can do whatever the rest of the market is doing. So it has that growth component that the fund managers aren't going to touch. Now, they can get bigger premium by writing higher coverage and more aggressive moneyness, but they won't necessarily do that. But here's where, depending on how the question is asked to you, you could also toss this right back at the other person. So if the question comes at you with like, well, there's NAV erosion, it erodes the net asset value, you could be like, I'll tell you what kind of erosion is more likely? Maybe you've explained your point. Like, I've just explained that It can erode over time, yes, depending on the structure of the fund. I've explained to you how that works. But what is more likely? Your attention span and your interest, the horsepower you put in towards your reinvestments, your contributions, if you're in a growth strategy that's only focused on the S&P 500 for 40 years. It's on paper, it's a very simple thing. Just chuck your money into the S&P 500 or into the whole US stock market. But what's more likely? That I'm going to stick with that for 40 years, really? On paper, and everybody says it's that easy. It's probably not that easy. I mean, you change as a person over time. Your goals change. I mean, when I was 25, I'm 35 now. My goals have absolutely shifted. I got into finance when I was 30, and my world has exploded because of it, to see what's actually possible. I would say what's more likely to erode away over time is my hunger to invest more, versus just simply chucking my money into a growth fund. Maybe I do better. Like, if you actually do that and you succeed at it, you're probably over the long term going to do better versus investing in CoveredCall ETFs with invested in the S&P 500. But here's the thing I think that investors need to consider. You guys need more wins on a regular basis to keep up your motivation. Your attention span is, well, let's just put it this way. As humans, we are not good at long term. We are just not. We're not geared that way. We need immediate satisfactions. If we're going to be investing for the long term, which means delayed gratification, how can we get wins on a more regular basis? And I'll put a picture on the screen here. This is one way that you could show of how that's possible, how you stay invested for the long term. And not only that, maybe you got passion behind it. Maybe you got, you're showing the other person that you're like, man, I am jazzed up about this kind of stuff. Look at how my income is growing over time. That's how it is for me, where I'm able to show people that every single month my income is growing, and I'm able to, I'm thinking of it as replacing my paycheck every single month, and it's growing faster and faster, and those bars between each month are getting higher and higher, and it's only just going to go faster the more you put in. You'll become much more passionate about this stuff. This is a very passionate community, and many of you have stories like this, and I reckon my logic and your logic are fairly in line with one another. But of course, as always, throw it in the comments about what motivates you to keep staying invested in the strategy. But this is the big one for me. It shows me that I am getting closer to the freedom. You know what? By the time I'm 65, to me that model is dead anyway. Just by virtue of the math, I'm not going to make it till I'm 65. I know I'm going to retire a lot sooner. I don't have a particular age or a date as of yet, but man, that window is within 10 years. And that's just and that is just simply the investing portion. If I just invest the same way I do without putting in any more, it's somewhere in there. And luckily, I like my job, so I get to build ships for a living, which is super cool, and I enjoy it, and I get to lead a team, and I just really like that. So to me, at the moment, I'm not exactly in the biggest rush in the world to get out of it. I just keep doing my thing, and I know I'll get there. There will come a day where I'm like, I'm showing up at work, but I don't necessarily need it anymore. It's like they need me more than I need them at that point. And that's what I'm working towards. That will be a cool position to be in. What's the more likely erosion, right? Maybe some funds out there that are poorly constructed, or your motivation, attention span to, say, some sort of growth style investment. So I had some other things that I wanted to bring up, but the video was going on a little too long. So I'm just going to leave it there for now. Maybe we do a part 2. Throw it down in the comments if you want to say maybe another version of this. But the first and foremost, of course, not just that, but throw down in the comments other arguments or questions you've faced and how you've responded to it. I think that's really important for the people that watch this video. They can go down there and see other arguments for themselves, not just necessarily mine, but let's get the whole community involved in this. I think some final thoughts around this. Hopefully, if you are invested in this kind of strategy, your ultimate weapon to defend yourself is really just being educated on this stuff, knowing exactly what you want, knowing how your investments operate, having a destination for your money is truly the best way of handling any kind of criticism. Hopefully you enjoyed some of the arguments that you can bring to the table, that you can bring to your workplace, you can bring to, the family dinner to defend your positions. With all of that being said, hit the buttons of the like and subscribe variety, and I'll see you all in the next video.